Module 8, Cash Flow Statements, Lifeblood of Business Operations. 1. Introduction. Cash is the oxygen of any business. While income statements reveal profitability and balance sheets display financial position, neither provides a clear view of how money physically enters and exits the organization. Many businesses appear profitable on paper but collapse due to poor cash management. This module introduces cash flow statements, CFS, a powerful financial tool that highlights a business's liquidity by tracking cash inflows and outflows across 3 fundamental activities: operating, investing, and financing. Second, the purpose of cash flow statements. The CFS is essential because it measures actual liquidity, unlike accrual accounting, which may include non-cash transactions. It reveals a company's ability to generate cash internally to fund operations. It helps identify dependency on external financing. It assists stakeholders in determining whether the firm can meet obligations, pay dividends, or reinvest in growth. 3. Structure of the cash flow statement. A cash flow statement has 3 major sections. A. Operating activities. These are the day-to-day cash flows from the company's core business operations. Cash inflows, collections from customers, receipts from sales of goods/services. Cash outflows, payments to suppliers, wages to employees, tax payments, interest paid. Adjustments, non-cash items like depreciation, amortization, and changes in working capital, inventory, receivables, payables. Example: a company shows a net income of 2 million naira, but cash from operations is only 1,200,000 naira due to increased accounts receivable. This reveals that although sales were recorded, much of the cash hasn't yet been collected. B. Investing activities. These represent cash flows from buying and selling long-term assets and investments. Cash inflows, sale of property, equipment, investments, or receiving dividends/interest from investments. Cash outflows, purchase of machinery, new facilities, acquisitions, or long-term securities. Investing activities highlight how aggressively a company is reinvesting for future growth. Negative cash flow here may not necessarily be bad if it represents strategic expansion. C. Financing activities. These involve transactions with owners and creditors. Cash inflows, issuance of shares, borrowing from banks, bonds issued. Cash outflows, repayment of loans, redemption of bonds, dividends paid, share buybacks. Financing activities reveal whether the business is relying heavily on debt or equity for survival and growth. 4. Methods of preparing cash flow statements. There are 2 methods recognized under IFRS and GAAP. Direct method lists actual cash receipts and payments, more transparent but less common. Indirect method starts with net income and adjusts for non-cash transactions and changes in working capital. Most widely used. Example: indirect method, net income, 2 million naira. Add depreciation, 500,000 naira. Subtract increase in accounts receivable, 800,000 naira. Add increase in accounts payable, 600,000 naira. Net cash from operations equals 2,300,000 naira. 5. Key insights from cash flow analysis. Operating cash flow, OCF, should ideally be positive. Persistent negative OCF signals weak core operations. Free cash flow, FCF. OCF minus capital expenditures. This reveals how much money is left after reinvestment to pay dividends, reduce debt, or expand. Cash flow, adequacy ratio. Measures: whether operating cash flows are sufficient to cover fixed commitments like debt repayment and dividends. Quality of earnings. High net income with low cash flow may indicate aggressive revenue recognition or poor receivables management. 6. Common cash flow problems. Overtrading. Too much sales growth without enough cash to fund receivables. Excessive inventory buildup. Dependence on short-term financing. poor credit management leading to long delays in collecting receivables. High capital expenditures without adequate planning. 7. Real-world importance. Investors look for positive operating cash flows before investing. Lenders analyze cash flows to assess repayment ability. Managers rely on cash flow projections for budgeting and strategic planning. Governments and regulators may review cash flows to ensure compliance and transparency. 8. Conclusion. The cash flow statement is not just a compliance requirement, it is a strategic diagnostic tool. It allows businesses to evaluate how well their profits are translating into real cash, how sustainable their financial structure is, and whether their growth strategy is supported by actual liquidity. For non-accountants, mastering cash flow is essential because a profitable company can still fail if it runs out of cash.